let's take the discussion forward with Ashutosh Bhargava, who's joining us from Nippon Asset Management, the fund manager at the multi-assets fund over there. Ashu, afternoon. Thank you so much for your time. First of all, before I take a dive in your funds and your strategy, a quick view on the way, policy paired out today. There was expectation that there would be some stance change at least. That did not happen. Forget about the rates, but it appeared that the governor was very steadfast on controlling inflation, and some commentary again on top-up loans and deposits being continues to remain an issue. What were your key observations from the policy commentary today?
Good afternoon, Najib bhai. So going into this policy, it's not that there was a consensus of a rate cut, but there was definitely an expectation of some changes stance towards more neutral, but that hasn't happened. It seems that the RBI is very focused on this 4% inflation target and overlooking already below 4% core inflation. To my mind, this is slightly disappointing because it is possible that real rates are already very high in the country. And, there is a right time to start indicating, easing of policy. And as you mentioned, particular focus on curbing the lending towards the consumer sector perhaps would further weaken the growth prospect of consumer consumption as a sector. Because in my view, monetary policy is far more relevant for consumption at this part of the cycle versus capex. And such kind of policy stance would further weaken lending towards the consumer sector. And I think lending is a very important element now versus any time in the history as far as Indian consumption is concerned.
Since you spoke about that, I want to understand how are you approaching the lending basket in your multi-asset portfolio. On the one side, there are large private sector banks which have been on the brunt of FI selling, over ownership, if we call it. But despite a reasonable valuation and good numbers, there are less takers. Then there are the unsecured or the lower end of the Fusions of the world and some others MFI names which are taking it on the chin because of what's happening in the environment. How are you approaching the lending basket of financials in your portfolio?
So, overall basis, lending has disappointed as far as earnings are concerned. Particularly, earnings have been weaker. There are some new concerns which have cropped up on the asset quality side, which I don't think should last for quarter or two. But the reality is that we are nowhere near the upgrade cycle in banks. The good thing about banks, the way we look at it, is the valuations. Banks are trading at significant discount to their own history as well as vis-a-vis the rest of the market. And this is where we are keeping the faith in the sector as a whole, but we are avoiding the weaker liability franchise here. The biggest problem in the banking sector today is the deposits. And therefore, we are sticking to the larger banks as far as banks are concerned. And on the NBFC side, we are more positive on, I would say, non-consumer NBFCs, which are more catered towards CV cycle or power sector. And we are also diversifying within financials towards non-lenders like insurance. This is one sector where we think this is right for some kind of outperformance over the next 2 to 3 years.
Insurance a little more because last budget onwards, for the last 5 years, insurance has underperformed. Then valuations. Do you think valuations are troughed out there from here on? Some insurance companies are giving their 3-4 year targets now. Government themselves, in fact, Deepam Sekhi was on our channel recently, spoke about how the focus is now to make LIC much more efficient and larger and technology-backed company. It appears that entire sector things are falling in place. How would you approach insurance? Health insurance, life insurance in general, which are the ones you like?
We're more positive on life insurance as a sector because, as you rightly said, there has been the sector has digested a lot of bad news. There has been a lot of regulatory, curves which has come to the sector, and we think we are well past the point where the bad news are all behind. And if you look at the earnings, they have consistently risen. while the valuations have come down. The way we look at it is that on a relative basis, it's not that insurance is going to deliver, uh, 20-25% CAGR earnings growth from 3 to 5 year perspective, but a good double-digit earnings growth possibility is definitely on the horizon. And on a relative basis, when we look at the rest of the market, where the overall market expectation of earnings are around 14-15%, given the price value gap in life insurance as a sector, we think this sector remains perhaps under-owned also, so it's not crowded, and price value gaps being supportive. So we are adding more insurance across our portfolios.
That's a key point. Ashu, how are you approaching the pharma space? I mean, looking at Lupin's commentary for third quarter in a row, some other numbers as well, be it either mid-sized companies, Piramals of the world. One is getting a sense that there's a quiet bull market which is happening as far as pharma goes. But still, I don't see many names in your portfolio. What's your approach on pharma overall, domestic as well as export-led?
So Ajay, we think that the valuations have run up quite a lot. As you rightly said, there has been a stealth bull market in the sector, and partly led by a broad-based earnings surprise, I would say, in pharma as a sector. But from here on, to identify many companies which can deliver uh, above average or better than markets earnings growth, we have our own doubts. So we think the best environment as far as profitability goes for non-domestic oriented companies, US centric companies, we think the best perhaps would be behind. And some of the profitability that we are witnessing in pharma sector could be short-lived. Because there could be a possibility that 1 year down the line there could be a sudden earning cliff. Some of the global-oriented names, we are more focused towards domestic-oriented companies. Yes, the valuations there remains slightly elevated, but from earning, the confidence of earning holding up from next 2-3 year perspective, I think it's better to look at domestically focused pharma company versus global focused pharma companies.
Fair point. I see a very good representation in some of the names in your portfolio which are either from either power financiers or even utility companies. I want to understand your view on power and also ancillary capital goods. Increasingly, a lot of your peers which have been coming on our channel and our show as well are even not shying away by saying that they are trimming some power ancillaries. Surprisingly, because they've had a very good run and valuations have run up. What are your thoughts on power as well, the entire value chain actually in power?
So I'm actually pretty positive. As a house, we are very positive. We think both the supply and demand side factors are very well aligned, and it's not a local theme. In my view, it's a global theme. And as you rightly pointed out, I'm positive on the entire chain. So there is a lot of capex which is imminent in transmission sector as well as on the generation side, and the whole chain will benefit. So right from the lenders to equipment providers and the utility company, as you rightly pointed out. The profit cycle perhaps would surprise most people. Yes, this has been well discovered to the last 1 year, so valuations are not cheap anymore. But the reality is that market favors earnings, and valuations when earnings are good sometimes take a backseat. And this is one sector where we have more confidence of earning being sustainably good over the next 3 to 5 years, and therefore we are keeping the faith. Then you would find in most of our portfolio a large overweight and power as a whole basket.
Before we let you go, one big call or some key theme to watch out for. Give our viewers something to chew on, something to study, something to look into a detail. Any theme you see faring away, which is still not in the price.
So in this market, most of the themes are discovered, but I still think that themes like as we just discussed, power, water as a theme. I think it has a great runway. Anything and everything related to water. EMS as a theme. Again, I think the this sector is becoming stronger and stronger with the passing time. And last, as I mentioned, insurance remain a good dark horse, the comeback sector. I see this is one of the comeback sector. Apart from that, this is a year where my personal view is that we should not take a lot of deviation away from the index. This is not a year where alpha should be generated through very active sector calls, where the focus, to my mind, has to be on creating alpha well within the sector. So it's cliched, but I think if there is any good time for bottom-up alpha creation, I think this is a time. And sectoral calls, big sectoral calls per se, perhaps should be avoided at this point of time.
Excellent. You are actually mirroring the sentiment which one of our common friends, Pankaj Tuewal, actually told us yesterday, that it's a time to be a risk manager, not a fund manager. The year is to preserve whatever you've made so far. Okay, Ashutosh, thank you so much for your time and have a good day ahead. That was Ashutosh Bhargava.
If you like this video, then like, share and subscribe to ET Now.